what is a capital gain? That is the objective of our YouTube video today. My name is Christopher Neufeld of Neufeld Legal, and in this video series we try to tackle some of the basic tax and legal principles to provide you with those conceptual ideas to build off of. What is a capital gain? A capital gain is the realization when you sell, or from a legal standpoint are considered to have sold, a capital property for more than its total adjusted cost base and the outlays and expenses incurred to sell that property. So now we have to first consider what these other concepts are. What is a capital property and what is one's adjusted cost base? So what is a capital property? It is a property that can include depreciable property, which, if sold, would either result in a capital gain or a capital loss. Furthermore, it is a property that is purchased typically for investment purposes or to earn income, as distinguished from trading assets of a business, such as inventory, which is not considered capital property. So what are some types of capital property? Well, land, buildings, equipment, typically used in business or for rental operations, securities, such as stocks, bonds, and units of a mutual fund. And next, what is the adjusted cost base that we're talking about in determination of capital gains? Well, the adjusted cost base is usually considered to be the cost of the property plus any expenses to acquire it. This is generally at the outset, such as commissions and legal fees. The cost of a capital property is its actual or deemed cost, depending on the type of property and how it was acquired. Furthermore, adjusted cost base can include capital expenditures, such as the cost of additions and improvements to that property. However, you cannot add current expenses, such as maintenance and repair costs, to the cost base of a property. Having touched upon these core conceptual components of a capital gain, we now must ask ourselves, when do we have a capital gain, or in some circumstances, a capital loss occurring? And that is when you either sell or are legally considered to have sold that capital property. So examples of a sale of capital property or a deemed sale of capital property would be where one exchanges one property for another, where property other than for cash is gifted to someone, where shares or securities in your name are converted, where you settle or cancel a debt owed to yourself, where you transfer certain property to a trust, where your property is expropriated, typically by the government, where your property is stolen or destroyed, where an option exists that you hold to buy or sell property expires, where a company redeems or cancels shares or other securities that you hold, where you change all or part of the property's use, where you leave your national jurisdiction, or where you die. In each of these instances, it is typically considered that a capital gain or capital loss will arise. The capital gain or loss may be negligible or zero, but these are circumstances that you typically be looking at with respect to capital gains and capital losses. Conversely, where you're using personal use property, such as cars and boats, these items typically don't incur a capital gain because they don't typically increase in value over the years. In fact, they typically result in a loss of value. Meanwhile, one's personal residence can occur a capital gain, but there are specific rules associated with one's personal residence that result in a different treatment of capital gains in that circumstance that one needs to be aware of and specifically address, because the different tax treatments can result in very divergent tax consequences, even though there are comparable increases between two different types of property, one being a principal residence, the other being a regular commercial piece of property. Now, what is the basic formula for calculating whether you've incurred a capital gain or loss on the disposition or deemed disposition of that capital property? Well, what you do is you take three core amounts: the proceeds of disposition, the adjusted cost base that we spoke to of earlier in this video, and the outlays and expenses incurred to sell your property. As such, you take the proceeds of disposition and you subtract from that the property's adjusted cost base and any appropriate outlays and expenses incurred in the sale of that capital property, so as to determine what the capital gain or capital loss is. Once that calculation is made, that number is applied to the capital tax rates, subject to whatever legal and taxable arrangements are available to yourself. But that is your capital gain or loss. If it's negative, naturally, it is a capital loss that you have incurred. So to reflect this in a very simple example, let us say that you acquired a piece of capital property, whether it is a commercial building or shares in a company. And the original acquisition was 5 years ago, and you acquired that property for $10,000. Pretty low number, just for example's sake. Now, 5 years passes by, and you sell that same capital property for $20,000. You take the $20,000, you subtract from it the $10,000 that was your adjusted cost base, and if you incurred another $500 in outlays and expenses to facilitate the sale, you would subtract that also from the proceeds of disposition number of $20,000, giving you a capital gain of $9,500. That is the resulting calculation that you would use to determine the capital gain in the most simplistic of forms. And as always, there are many tax and legal modalities that have to be considered, but for the sake of providing you with the most clear and basic understanding of, in the most general terms, what a capital gain or capital loss is, that is how we achieve that determination. And hopefully that provides you the clarification and understanding that will allow you to move forward with an understanding of capital gains. Thank you.